Namaskar viewers, I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ right here on ITV Gold. The show is brought to you by Sai CPS Services, a professional full-fledged accounting firm located in the state of New Jersey, multiple locations, but they can assist you with your personal or corporate taxes wherever you are in USA. They're easy to reach and they believe in doing taxes right. They're on-hand, knowledgeable, experienced CPAs at any time will guide you, navigate you by setting up an appointment with them by phone call or even a Zoom call. It's all possible. For more information, give them a call at 908-888-8900 or visit their website scicpsservices.com. With that note, I'd like to welcome Mr. Ajay Kumar of Sai CPS Services, who is a CPA, CVA, and MBA with over 25 years of experience and knowledge and expertise that he has developed in the world of taxes and accounting and everything, that he joins us every week to guide us and inform us about taxes. Ajay, welcome to the show. Good to have you.
Absolutely, Sanjay, and thank you. Thank you for the kind introduction.
Sure, absolutely, because I know Science CPS Services all these years, and I know that how professional they work, and that's why it is my duty to let viewers know that for any tax matter, you should consult Science CPS Services. At least set up an appointment, have them review your taxes, and see how they can help you, and you'll be very pleased. I can almost certainly guarantee you with that. All right, so moving on with the show, and today's topic is very interesting. Okay, we are in month of November. Nobody wants to think about taxes. But I always say in the episode is that this is a time, November and December, this is a time to accumulate all your tax information, as many details possible, especially if you are a high net worth taxpayer. That means obviously you want to save taxes, and our tax codes and regulations allows you to save taxes. That means you can invest money somewhere else and reduce your tax liability. So that's a one thing, and I say that you must do it before December 31st. So this is the time for you to review that. Second is that if you have a foreign bank account and foreign income, you really need to pay attention what AJ has to say in this episode. It's really important because what's happening in USA by the government of USA can also have an effect on your foreign bank accounting and the incomes and everything that you have. So let's hear from AJ a little more detail on FBAR and FATCA, known as FATCA.
Absolutely, Sanjeevji, and you are very right. Right now, this is the time for planning. With the current immigration situation, with the current political situation, you need to take a step back, take a look at your current situation. Do you have properties in India? Do you need them? Do you have bank accounts in India? You want to simplify your situation. How much money do you need in India? What are the rules around FBAR, foreign bank account reporting, FBAR filing? What are the rules about foreign asset reporting filing? We call it FATCA filing. The last thing you want is to miss something unknowingly. The best part, you ask? There is no taxes when you file FBAR or FATCA. FBAR and FATCA, they are both information filing. It does not create any tax liability. What it means is you have absolutely no reason not to file FBAR and FATCA if you are expected to file. If you are supposed to file, please do yourself a favor, keep it clean. You do not want the system, especially if you are a green card holder, especially if you are here on a residency visa, you do not want to give the system an excuse to say you did not do something that you were supposed to do.
Absolutely. AJ, first question I want to ask you is that the purpose of this, even though you explained it, but the purpose that we know, but what if somebody still ignores it? What could happen? Let's start with this, hypothetical question that the purpose is to file it to let U.S. tax department know that you have these foreign bank accounts and income. But if someone continues to ignore it, what could happen?
Well, we have to look at the magnitude of the situation. We have to see how much money you have. Then we have to know if it's a willful neglect or you made a mistake out of it. And then we have to see if you are an accredited investor, if you are making more than $250,000 for at least 2 years, meaning it's a holistic situation that we'll have to see. If you take a step back, the worst case scenario is really, really bad. The way the rule was designed, when the September 11 happened, a long time ago, when the World Trade Center fell, they decided, they did a lot of research into it. How did it happen? Why did it happen? And what could have been done to prevent it? And one of the conclusions was it takes a lot of money, lot of transactions, lot of foreign money to do something like this. So if we can track who has foreign money, if we can track the transactions around it, the maximum amount, the minimum amount, then probably we could have found it out. So the worst case scenario has been made really worst. Not only it carries thousands of dollars of penalty, it has the jail time. The maximum penalty could be 400% of the amount you had at any time in the account. If you had $15,000 in your bank account outside this country, the penalty could be as much as $60,000. You do not want to be thinking about the worst case scenario. The advice here is there is not enough money to get into trouble. So you want to understand, you saying I did not know it is not going to work, doesn't work anymore. We have a new regime here. We have new political situation, new immigration situation. Make sure you take a step back, look at if you're supposed to be filing the FBAR, look at this episode, do some research. We'll give you the details, we'll give you the limits, we'll give you why you should file, when you should file, and how you should file. But the onus, the responsibility remains on you to make sure you file FBAR and FATCA.
Okay, very interesting. Now, now we know the importance of the filing of FBAR and FATCA. What are the foreign assets that should be reported in US, which falls under FBAR or FATCA categories?
So FBAR is more related to liquid assets, Sanjeev. So it's called foreign bank account reporting. It includes the mutual funds. It includes the cash value of life insurance. It includes PFIC, other than the regular checking, saving, fixed deposit type of bank account. Anything that can be converted into liquid asset, money, actual cash overnight is what's covered under FBAR. And again, FBAR covers the regular bank accounts, fixed deposit, checking, saving. It also covers the mutual funds, stocks. It also covers cash value of life insurance, which you can liquidate overnight. It also covers PFIC. On the other hand, FATCA for an asset is more about fixed asset. FATCA reporting is meant for, I used to have a house, or my parents passed away, they left a house for me, or I invested into a house where I was paying some X amount of money every year. Now it's on rental, I have a shop. Anything that's designed as a fixed asset. It could be your investment in a business over there. It could be the house that you used to live in over there before you came over there. Now it became an investment property for you because you have a house here, because you have a primary house here. So all the fixed assets are covered under FATCA filing. All the liquid assets are covered under FBAR filing.
FBAR, okay. Fixed asset and a liquid asset. Very good. Are there any thresholds which falls in these categories, FBAR and FATCA?
Absolutely. So if you are listening to us, please grab a pen, especially when we talk about the FATCA section. There are several limits around it, but FBAR is easier. Foreign bank account reporting is easier. If you had more than $10,000 at any given point of time during the year, in all your bank accounts added together, you have FBAR filing obligation. So let's take an example. If you had your Punjab National Bank had 2 lakh rupees, you had State Bank of India another 3 lakh rupees, then you had a local bank, you had another 2 lakh rupees. So in total you have 9 lakh rupees, which is over $10,000. Take another example. You have 5 lakh rupees in Punjab National Bank. You moved 3 lakh to State National Bank. Out the same 3 lakh, you closed the State National Bank, you moved it to another local bank, Bank of Baroda. You still have the filing up, it's the same 5 lakh, but if you add the maximum amount in all accounts added together, you have more than $10,000. You say, hey, it's the same 5 lakh rupees that I'm moving to three different banks. But again, we are not charging you any taxes. The idea is not to say that this is the tax you owe. The idea is to track the transaction. We are trying to see how the transactions are moving. Go back to the intent of the rule. So if you had more than $10,000 in all bank accounts combined together, you have an FBAR filing obligation. In that case, you're supposed to file, you're supposed to report the maximum amount in all the bank accounts that you had, along with the bank account number, bank name, bank address, and the maximum amount. So again, going back to the same example, if you have 5 lakh rupees that you're moving around, you will be reporting 5 lakh in a Punjab National Bank, 5 lakh in Bank of India, 5 lakh in Bank of Baroda, even though it's the same amount, but we report the maximum amount in that bank at any point of time.
Okay, interesting. Let's say if somebody has 10,000 or equivalent to 10,000 currency in India in one or several bank accounts, doesn't matter. When they report it here, the number one question that any taxpayer would have in mind, would I have to pay taxes? How much taxes would I have to pay? I have maybe 10,000 now. Next year, I may have 25,000. So let's talk about tax implications on the total amount that they have in their India's bank accounts.
And that's the best part. There is absolutely no tax on this amount, zero tax on this amount. You can have $10,000, you can have $10 million. We just want to know how you got this money, where you got this money. Let's say hypothetically, if you sell a property in India, then capital gain is taxable. You probably filed the taxes in India, you will report that amount in US, but just because you have X amount of money in India, X amount of money outside this country, does not create a tax liability. You can have 10,000, you can have 20,000, you can have 50,000, and it could be coming out of your provident fund, it could be a gift from somebody, does not create a tax liability over here. The tax liability is created by the transaction. If you say, I have a business over there and I'm earning money, then you should be filing the Indian taxes, and the taxes that you paid to the Indian government becomes a tax offset to the US government. There is no double taxation here, and there is no taxation on reporting in FBAR or FATCA.
Interesting. All right, so that's good to know. Last question before we go into the break. All right, pension money, provident fund money, obviously they pay taxes in India, so there's no double taxation here. What if somebody sells a property over there? I assume someone sells a property and they pay whatever the taxes, capital gains and local, state, city taxes, whatever, they pay that. And if they want to bring that money here, let's say if it's $100,000, what do you suggest to them?
Well, you have the legal right to bring this money. We just have to report it.
Correct.
So you sell the property in India, and your capital gain is $100,000 in this example. So this $100,000, you paid some taxes in India. In India, remember, we use indexing. So you have to see how much capital gain taxes are paid. Let's say if you paid $10,000, you bring this money over here. We say, well, what is this money? Oh, this is capital gain tax. I already paid tax in India. Oh, from our perspective, you fell in 15%, not 10%. So you pay us 5% more in this example. So there is no double taxation, but in this example, in many situations, you may end up paying a small amount to the US government as well as an Indian government if there is a tax difference. If the US tax bracket is higher than the amount of taxes that you paid in India, and you say, how do I know the tax bracket? You have to look at a whole situation, how much money you are making. The system, US system, has multiple tax brackets depending on the income that you have.
Okay.
So if your US tax bracket is higher than the Indian tax bracket, in that case, you may have a small tax. The difference may need to be paid as well.
All right, very good information. The bottom line is it must be reported. So that's what the summary of the first half of the show is. In second half, we're going to go a little more deeper. So stay with us. We'll be right back after this messages for the Tax Talk with Ajay. Thank you. Let's continue the second half of the show. Today's topic is FBAR and FATCA. This both have to do with your foreign bank information, foreign bank accounts, assets in the foreign countries such as India or anywhere else in the world. That must be reported here on your US tax return just for reporting purposes. But there are some details that you really need to know. In the first half, AJ gave us a lot of information, and the bottom line was that you must report it. Don't worry about the taxes in the US, because the taxes may not apply to you. You may not have to pay taxes. But if you don't report it, and if they find out, then there's going to be a huge penalty. All right. So let me start with this question, AJ. My question to you is, let's say if somebody didn't report it and somebody wants to report it, or somebody wants to amend the tax return, how many years can they go back, if it's possible to go back?
So there is no such limit in how many years they can go back. The question typically asked is how many years they should go back. And we look at the situation, the magnitude of the situation. If we are doing just the FBAR filing, we can go back 3 years generally to do the FBAR filing. If there is interest income that was earned and was not reported, that changes the situation. We'll have to look at the magnitude of the whole situation. If the interest earned is a small amount, we can just amend 1 year and include the last several years' interest together. If the interest earned is significant as unreported income, meaning they earned interest in India, they did not report the foreign bank accounts, they had some TDS deducted, in those cases we have to take a look. But generally speaking, we recommend going back 3 years to amend the returns for FBAR filing. Please understand, you cannot do FATCA filing separately. FATCA filing requires an amendment. It's mandatory. You cannot do 8938 filing without amending the taxes. FBAR, on the other hand, can be filed separately without actually going through the full amendment.
Okay, very interesting. Now let's just talk about, I know in the FBAR you mentioned to us that 10,000 is the limit. On a FATCA, can we go a little bit more detail, as the threshold is anywhere, if I understand correctly, $50,000 to $600,000, but it all depends upon your status. How are you filing a tax return?
Absolutely, very well said. So even though it seems that the limits are 50,000 to 600,000, which is absurd high, but if you take a step back, if you are a US citizen, if you live in US and you are a single person, then the limit is 50,000, meaning if you have foreign assets over 50,000 during any time of at the year end, then you must file FBAR. If this 50,000 limit changes to 75,000, if the same asset had more than 75,000 during the year, meaning the rate keeps fluctuating, you had a property, you sold the property, so the year-end limit is 50,000, during the year at any time 75,000. If you are married, this 50,000 changes to 100,000, and during the year changes to 150, meaning if you are married filing joint, if you had more than $100,000 of asset at the end of the prior year, you have FATCA obligation. During the year, during the prior year, if the assets were worth more than 150, then you have the FATCA filing obligation. If you're living outside US, the limits are 4 times higher, meaning the 50,000 goes to 200,000. If you are a single person and if you have assets worth 200,000 at the end of the year, then you have the FATCA filing obligation. The promise here is you are a US citizen, US green card holder, US resident, living outside US and filing the US tax return. In married filing joint cases, the limit is $400,000 at the end of the year, or $600,000 at the end of the during the year. So the $50,000 single filer living in US goes to $600,000 when we talk about married filing joint, the couple living outside the country. So you have to be careful in what limits you fall in, and if you have the FATCA obligation. If you do have the FATCA obligation, the form that you're supposed to file is 8938, and this form cannot be filed separately. The form must go together with your personal tax return. The deadline for 8938, meaning FATCA filing, and the deadline for FBAR filing are the same deadline that you have for your personal tax filing. If you extend your personal tax filing by filing an extension, in that case, your FBAR and FATCA filing obligations automatically get extended to the personal tax filing deadline. So if the deadline is generally April 15th, if you file an extension, then it's extended to October 15th, 6 months.
Okay.
In that case, FBAR and FATCA is also going to be due by October 15.
Very well. Now, okay, having said that, now got all the details about FBAR, FATCA, and why it needs to be filed and limits and everything. My question to you is that we are in USA, the taxpayer is in USA. How do you value foreign assets?
It has to be a general value. The question generally that we are asked, I bought it for $100,000. I don't know what the value is. We don't care how much you bought it for. What we care is what's the current market value of this property. In the worst case scenario, you can ask a realtor, you can ask a broker, I want to sell this property, how much can I get? But at the end of the day, it's your value. As long as in the right range, we are okay with it. And remember, the promise here is we are not charging you any taxes. It's not a taxable transaction. It's an information filing. The last thing you want that you report $50,000 of asset, and after 6 months, you end up selling it for $5 million, then we'll give you a hard time. 6 months ago, you told me it's $50,000 worth, and you did not do the FATCA filing. Now you are saying that you sold this asset, which is $5 million. How did it change in value 10 times over 6 months? So you want to keep it honest as best as possible. Again, there is no taxes associated with it, so keep it in the right range.
Okay, excellent. Now, the question I have after hearing that, do you need to submit the foreign bank account statements or any transactions of capital gain and whatever it is as a proof? Let's say somebody has $100,000, right? Whatever, however, combined together. Does IRS require to submit bank statements of foreign bank accounts?
No. See, the US tax system is an owner-based system. When you say, I donated $10,000, we are not asking for the receipt at the time of tax filing. We are expecting that you have a contemporaneous receipt, you have a receipt in hand while you're claiming this expense. Same thing if you are claiming some deductions for the foreign taxes paid or foreign capital gain or local capital gain. We are not asking for any proof at the time of filing the taxes. Not that we cannot ask for it if somebody gets audited. They have to have those proofs for the capital gain, foreign transaction, taxes that they paid to the foreign government, the taxes that they filed with the foreign government. We will see all those details at that time. But at the time of filing the taxes, those details are not needed. They do not need to be submitted with the tax filing.
Okay, so then the question is, how does it impact FBAR or FATCA? How does that impact for a taxpayer here in the USA and even for IRS?
So for the taxpayer, if they keep it clean, if they keep it honest, then, and if they keep reporting their foreign assets, then tomorrow when they sell these assets, they have a legal claim. Remember, I told you I have a house in India, and I have been telling you the same thing for the last 7 years. That's the house I sold.
I see.
So it's easier for them to justify where they're getting the money and why are they getting a lot of money from a foreign country.
Okay.
From the government perspective, this is an idea about tracking where the money is going, where the money is coming from. And the US system wants to track, again, going back to our earlier example, when any big terrorist activity or any big fraud happens, it has a lot of foreign transactions involved in it. So the idea, the intent, right from the inception was not to collect taxes, but to track such transactions.
Very well. Having heard from you, obviously, the importance of FBAR and FATCA, and the summary of this episode is that you must report it, because do not worry about the tax implications here in USA. You don't have to pay taxes, but for your future transactions, when you want to transfer the money from that foreign country to US, at least let's make it easier. And if it's a large sum of amount, might as well make it easier for everybody. So that way one is that there is no penalty for you and there's no question from IRS. So it makes it very, very certain. And all you need to do, just let them know that how much money you have in the foreign bank accounts and what's its worth and what's the value and everything else. So that is that. Now, viewers, this gets quite complicated and difficult to understand in one episode, because you really need to know, and everybody's situation is very different. What AJ is telling us is in a simple man's language that this is what you need to do. But should you really want to get some details, I suggest contact Science CPS Services. Give them a call, set up an appointment. In-person appointment would be much better if you are in local area. If not, obviously Zoom call would work also. Set up an appointment and let them review the whole situation, and they will advise you and guide you, as they have been doing it for hundreds of thousands of clients for over 25 years. So Science CPA Services for all your accounting and the tax needs. And by the way, they also can get you virtual CEO and CFO and also payroll manager in case if you want to focus on your small business, mid-sized business. So they can do that too. So do contact Science CPA Services, 908-888-8900, sciencecpaservices.com. Ajay, many thanks for your for your input and sharing all the valuable information with us. I am Sanjeev Pandya, wishing you all happy and the tax-free days ahead. Until we meet again, same place, same time, and next week when we bring another episode of the Tax Talk with Ajay right here on ITV Gold. You do take care of yourself. So long.
Thank you.